Hello and welcome to Jim Dalton's presentation, How to View the Middle of the Trading Day, and an extended session to cover current market conditions. My name is Julia Stewart. I'm Jim's partner here at J. Dalton Trading. I'll be taking your questions and moderating this presentation. Jim and I want to thank all of you for coming out today and being a part of this. We very much appreciate your participation. And it's great to see you all. So please type your questions in as you have them. We'll get to as many as we can. And Jim's got a full plate here to present to you. So I am going to quickly turn it over to Jim and let him do his thing. Hi, Jim.
Hi. I don't know if everybody will be able to get on. We have a record number today, at least registered for the webinar. This webinar is going to be repeated tonight. We're doing it for Peter Resnicek. What time is that? Oh, tomorrow night. I'm sorry.
With Shadow Trader, 4:30 Eastern Daylight Time, tomorrow, Thursday.
We may make some tweaks to it depending on how today goes and things that happen. But just so you know that it will be shown for Peter tomorrow night.
Jim, may I interject something
sure.
Before you get started? Hi, everyone. Very quickly, while we're talking about webinars, tomorrow we have our Kickstart program in play. It's a 7-week program to help traders prepare for the Mastery Series. Of course, it is for Mastery Series traders who are enrolled, but we've also invited all JD members, and you're a JD member if you've purchased anything from us, a download program, an intensive attendance in the past, a Chicago seminar, Paris seminar, wherever you've been with us, you are invited to attend these Kickstart webinars. So if you are not getting emails or you haven't attended, tomorrow is our second of 7 Kickstart webinars at high noon Eastern Daylight Time. And all Kickstart webinars and reports, because you're getting 2 reports a week, are posted at training.jdaltontrading.com. And you can go there to get today's report, even if you're not a JD member, and you can go there to register for the Kickstart webinar tomorrow at high noon. These Kickstart webinars are password protected. You should have received a password in the email that you received, but you can always shoot us an email at jdaltontrading@gmail.com, and we'll make sure you're in that webinar if you want to be. Okay, so thanks for that, everyone. Back to you, Jim. Thanks.
Just one more comment on the Kickstart. I was amazed. Last week was billed as very fundamental. We had some very serious traders that I was surprised it wasn't really intended for them. This was intended to get people that are going to be new to the Mastery Series up to speed. But these senior traders remained on for the whole period and came away. I got several comments. Julia got several comments that they found it very helpful and refreshing. So anyhow,
yeah, if you weren't, pardon me, I'm interrupting again. If you did not see that webinar, it's the first Kickstart webinar. It's at training.jdaltontrading.com under Kickstart webinars, recorded webinars, and Jim did a phenomenal job of explaining how he views the market through the two-way auction process and why he uses the profile to formulate his trade decisions. Just an amazing, I've seen Jim do this introductory webinar many, many times, but just the way God would have it, it was just an amazing presentation. Okay. So that if you haven't seen it, you'll really enjoy it. That's it. Thank you.
Okay, and remember, if if you're joining the Kickstart program, the faster you get registered, the faster you get to these and view them. But they've been very beneficial too, from what I've been told. Okay, let's continue forward. Are you ready to get serious? And one of the things that I'm struck by, I'm continually hearing from and talking to people that have been clients for quite a period of time, and their frustration of not quite getting to the point that they want to get to. There are some consistencies when I talk to people. They are consistently looking for exact places to get in and get out, and they are consistently looking at very short-term information on a continual basis. and I think this is blinding. And I'll show you some things here later this morning. Anyhow, information is the driving force of all markets. Information has no power until someone acts on it. Understanding human nature is the key to understanding the totality of the auction process. This is a huge concept, and this is really going to be an awful lot about what I'm going to show you today. Looking just at price, looking at numbers, it is very unlikely that that is going to get you over the hurdle to being a profitable, successful trader. Current market conditions, a change in market behavior may be underway. And so as you know, a lot of you know, we go from bull to trading range, back to bull, or bull to trading range to bear. So but we don't go directly from bull to bear. So how is a bull corralled? A bull is corralled by being penned in. In other words, this is the bracketing process. And the bracketing or balancing process from a long-term auction is nothing more than a period of time in which the long time frame buyers and sellers move closer together in their beliefs of the value of the marketplace. As the market has been rising here for many years, there's been a consistent belief that the market has been cheap or has been undervalued to the seller and has been an opportunity for the buyer. So the belief between the long-term buyer and seller has had quite a separation. Now, as if the market starts to this bracketing process, that just is a process by which the belief in value of the long-term buyer and seller become much closer together. Once it comes together, then we find we usually either revert back to the bull or the market reverses and turns into a bear market. But it is very seldom we go from bull to bear. And the reason I call this an updated webinar today is I believe that process may now be underway. Whoops. So we just talked about this a minute ago. Okay, what I've done is just taken you through a market. So you see the process by which a market starts to show it's getting close to the end. You'll see we had a short-term balance. The market then broke out of that short-term balance and we moved sideways. This was a holiday, but then we moved sideways for 5 days. Then we had this huge gap to the upside. And that has been the high, even though there's no excess on the high. We examined this particular day in some detail. It's in many of our reports. And at that time, we thought there was an indication that this market might have been very much overdone. One of the clues was the afternoon pullback low. That was a reference that was easily taken out the following morning. Excuse me, hold on just a second. Oh, I'm sorry. And then the market from there, one time frame lower for 1, 2, 3, 4, 5 days. But in that process, notice that the market moved sideways, but it's now overlapping this previous trading range. When we start to see these congestion areas or where there's backing and filling taking place, overlapping the previous area, that is usually an indication that the market is getting very tired. It doesn't roll over immediately. It's a process by which it rolls over, but once you start to learn that process, it becomes much easier to position yourself for short-term trades. Then we rallied off of the Fed day, and we're going to come back and we're going to look at this this day in some detail before this webinar is over. We had 2 inside balancing days. We broke to the downside, and then we got the outside day yesterday. notice that that outside day yesterday comes back through all of these lows, all of these lows, and all of these lows. So you get some idea. This process was telling me that the market was getting very, very late in the process. Plus we had an excess high. For those of you that got our weekend letter, we're putting out one letter on Sunday, and then we're updating it on Wednesday for those that are in the Kickstart program, or for those that have that are JD members. It's like American Express. Membership has its privileges, and we've provided that. But in the letter that came out this Sunday, and we'll talk about it later, what I said was I was now trading the market from the short side. We'll examine that in a little more detail, but you see the full culmination of that yesterday. Okay, following the Fed day, and again, this is the Fed announcement day. Early on when we started, we said, you're not going to fully comprehend the market without the information of understanding the other competitors in the marketplace. It is easier to understand what those people are doing if, in fact, you know how to read structure. So the day following the Fed announcement, we had a gap, and that gap is going to come back, and we're going to be talking about that gap again. The market on that day following the Fed rallied. The pullback, late afternoon pullback low was to right where the arrow is, and then we settled here. What I wrote at that period of time was, if in fact that was really strong buying and not late momentum or laggard buying, I seriously doubt that the market would have pulled back that far. It might have pulled back a little bit, but it wouldn't have pulled back that far, in my opinion, and then we closed well off the high on that day. And from that person, when I looked at this day, from that time on, I have been trading the market from the short side. And I've been trading from the short side because, one, we had an excess high a week or so earlier, 2 weeks earlier. This day was attempting to go for that high. It looked like an awful day. The point of control did not rise. The pullback was too much, and the settle was way off the high. Had this been anything other than laggard, late momentum buying, I seriously doubt that we would have had, I don't know what I just did, that we would have had that kind of structure. So looking at that, it was my opinion that we were very, very late in the auction process. And from that period forward, as I wrote last weekend, I've been trading the market from the short side. Now, you see, yesterday was the outside day, but one of the things, and let's see what the next slide shows. Okay, one of the things you'll notice, the day before yesterday, on Monday, the low was exactly into the gap, one tick into the gap. When you have a very mechanical reference such as that, and then the market rallies, it is usually an indication. It is usually an indication of very weak money. Now, today is billed as how to trade, what to do midday. And as a short-term midday trader, I'm going to go off of the slides for a second. I'm going over to the market itself. Oh my golly, somehow my market shut down. I'm sorry. I'll be just a second. I'll be bringing that back up, and then but I'll go back to the slides in the meantime. That takes, I don't know how that happened, but it takes a little bit to load. In the meantime, before we come back to that market, we'll go back to the slides. Okay, so when we said this is an updated market webinar today, and I was talking about this idea of why, and it's because we may be looking at the beginning of a major change in the market. And that major change may be the fact that we're starting a bracketing process. So I start and I look at the monthly bar. So the monthly bar yesterday settled on the low. So when you look at the monthly bar, it's still been one time framing higher for 1, 2, 3, 4 months. So you look at that, well, you don't see any, there's no signs there that anything has changed. Next, you go to the weekly bar. And for those that have been with us for any period of time, I don't care how short your trading is, we plan for each day by starting by reviewing the monthly bar, the weekly bar, then we go to the daily bar, and then we go to the profiles. It's a top-down approach in order to have some assessment of what is going on in the longer term of the market. Or is there any indication of change occurring? And we look now at the weekly bar, so we see we have a downside breakout from two balancing weeks. So we clearly have a downside breakout relative to the weekly bar. The weekly bar is going to break either with or ahead of the monthly bar. Next, we go to the daily bar, and when we look at the daily bar, there's something really interesting in here. We see that this came down in a very mechanical manner. When it comes down very mechanical, I mean, you can almost draw a perfect trend line here. You want to be very careful. This is mechanical selling, very dangerous, and this is a market that's more than likely getting too short. With traders, selling is close to the previous high trend line, as they can. And this is, again, it's a sign of mechanical trading. It is usually a sign of weakness, and very often these are taken out in a non-linear move, and what we call the firecracker effect. And the firecracker effect we developed simply because these highs are so tightly squeezed together that once you take one of them, that triggers the stop to the next one, the next one, the next one, the next one, etc. And as you'll see, that actually happened on the Fed day. So they caught the shorts, they had the mechanical selling, caught the shorts, and on that day we took out the high for 1, 2, 3, 4, 5, 6, 7 days, all in one day. Very, very common type of thing that happens. It's the firecracker effect. But then we come and say, okay, following that, so we cleaned up the shorts. And sometimes we say very often, a market can't go any lower because it's too short. So the saying is sometimes the market has to rally before it breaks. And sometimes we say it has to break before it's rallied, just the opposite. In this case, the market needed to rally before it broke. Now, and then Pastor says, well, why does it need to rally? Because all the shorts that were, again, we're talking about human nature, all the shorts that were in this market, they get overly anxious, they're mechanical shorts, they're weaker shorts, and what happens when you get the market too short, they get too nervous, and every time the market goes down a little more, they cover their shorts. How do you cover a short? You buy. So every time the market goes down a little more, they become buyers, and they stop the market from going down. So you need to clean that up, and we got the firecracker effect, we got the big day up, forces these shorts out. Now remember, one of the things that we also teach is that short covering can weaken a market. And short covering can weaken a market because it removes those shorts. And remember, shorts are potential buying power. Shorts are a form of support. So once you remove that support or that buying power into the market is much more vulnerable now to a trade, a more meaningful trade in the other direction. Very, very important. So now we get yesterday, and the market breaks out to the downside. So we have a downside breakout on the weekly. We have a downside breakout on the daily. But what I want to call your attention to is, notice we had overlap here. It provided some support. We had overlap here. It provided some support. They're like elevator stops. So if the market drops, there's a tendency for the market to at least pause in those prior areas of congestion or balance, whatever you want to call it. But if you look underneath from the yesterday's low down to the 2300 level, there is no balancing. There's no back and fill. There's no elevator stops. So this area down to the 2300 level becomes very vulnerable. So I don't think it's going to do it today, and I may not do it, but this is something to be aware of, that it wouldn't be terribly unlikely to see a decline fairly quickly down to the 2300 level. If that occurs, then we're sitting looking at the beginning. So if we looked at a single weekly bar chart, what you'd see is a much broader line. And a lot of times this early break from when the markets have been making new highs, this early break will extend over a period of several days, and it will form the left-hand edge or the trading range that may exist. As we say, markets go from bull to balance or trading range, then back to bull, balance, trading range, or revert to bear. So the reason that we said it's an updated webinar this morning, we may be in the process of establishing that trading range. Once that trading range is established, it then usually becomes a pretty reliable trading range for intermediate term traders. Day traders and short-term traders have a better idea of where the containment is and trade location. So it's an important process. All right. Before I go to the next thing I want to talk about, Julia, let me just stop and take a few questions on what we have talked about so far.
Sure thing. How does Jim define the March 3rd through March 14th? I don't know if he's referring to balance. For instance, why is March 2nd not included? On the contrary, can we see that?
I'm sorry, I can't.
Okay,
let me go to
March 3rd to March 14th. There's a little bit of art to determining balance areas. We know this. You've been using this balance area, the March 10th high, and I can't remember the weekly low on March 9th, or I'm sorry, I'm going from memory. So
okay, now give me the dates again.
March 2nd, or I'm sorry, March 3rd to March 14th.
I don't know.
Also, let's, okay.
This is just, the balance areas I showed were the balance areas that I saw. Okay, I'm sorry, I can't focus enough to be specific. March 3rd, March 2nd, was it?
March 3rd, he said. But we can move on to another question.
Okay.
I'm not asking it very clearly. March 16th and March 20th had poor highs. How much relevance do you put on these?
I'm aware of them. I'm aware of them, but I don't get overly concerned. I take the market one chunk at a time. I have seen, remember, one of the things that I wrote sometime for people that have been around for any period of time, that is not uncommon. It is not uncommon for the S&Ps, as they make all-time highs, not to really leave any excess. And the other thing, but the other thing I said that it's poor highs can be a result of a market that has gotten too long. And that's exactly what I think happened in this case, that the market got too long. Am I aware of those highs? Yes, I am. But if you'll notice, over the weekend, if you read the report or got it over the weekend.
We dragged the report to the handout section, by the way.
Okay. What I wrote on the scenarios, and every report that we do, and what we're encouraging for the Mastery Series is that every day I will do a report, and every day it will have multiple scenarios, at least 3 scenarios. So I wrote this weekend, my favorite scenario was short, and for the reasons that I've talked about already. And then the second scenario said, you can't, however, you can't be surprised if you do get a rally because of the poor highs. I'm conscious that they're still up there. However, there are only 2 data points. The other information I was looking at suggested, which I've talked about this morning, that the market had gotten very weak. And I was putting more structure into the big rally we had following the election and the rally following the Fed day. They looked particularly weak to me, and they indicated to me that I thought that the market was very heavy, and I thought we were getting in the late stages with weak buying. Okay, a couple more questions.
Does Jim ever merge days together on his profiles?
No, I do not. And that question comes up quite often. And the reason I don't is because I lose too much detail when I do that. And the detail is very important to me, and particularly if I'm engaged in short-term trades. Okay, what I want to do now, I want to go back. I'm going to take out I'm going to leave the overnight in for now. I want to go back to Monday. And this is, and I'm going to show you something else later on. These are the kind of things that can give a trader an edge. Now, people always want to know, well, where do you get in, where do you get out? I can't answer that question, where do you get in and where do you get out. But when I look at the low on Monday, notice that the low on Monday exactly matched the low from 3 days before. When I see that low, I have a pretty good idea that that is a weak low, probably caused by one of 2 things. Mechanical buyers buying exactly at a very visual reference, and people that only buy until they can get to a visual reference are generally not the strongest hands. They may be smart short-term traders, but they're not the smartest, they're not the strongest hands, because those people will turn very quickly and trade the other way. The other thing is that there's more than likely short covering that takes place from that level. Now, today was billed as trading intraday, midday. What do you do midday? This was a great example of midday trading. Notice, and I'm going to collapse this. Okay, midday on Tuesday, the market was very short. The point of control was up. We were building a 45-degree line. Okay, the 45-degree line is something that we talk about quite often. It's showing the point of control. We're drawing a line, in this case, from the low to the point of control, and at that point in time, since the point of control has not migrated lower, another way to think of the point of control is the fairest price at which current business is being transacted. So if this is the fairest price and the market's trading down here in the afternoon, short-term traders are getting caught short in the hole, and means short at bad prices. And as you see what happened, you know, you're talking about it's midday. What do I do midday? Well, you're watching and saying there may be a problem developing here, and you got the short covering rally going into the close. Now let's talk a little bit more about trader behavior. And I'm going to go back. I'm going to add in the overnight. So trader behavior, we had the short covering rally late in the afternoon. The high went up to the opening, and now overnight, a lot of traders do nothing but follow price. So they saw the last move was up in the day. As the overnight trade takes place, they take the market up and take out the morning high. Now, the morning high was poor to begin with because there was no excess on that high. So at that point in time, you know, I'm looking at that and I'm saying it's probably weak trading. The overnight trade is high. We know we look a lot at overnight inventory. Overnight inventory was long, and it wasn't like it was elongated, and it wasn't like the market just, you know, just solidly continued higher. And when it goes this wide overnight, that's really not strong buying in there. Sometimes you'll get overnight, but it stays, you know, fairly thin, and it's really pretty strong. You don't get this kind of sideways movement. But this is probably non-thinking people just following a price-based approach to the market. So, but this is yesterday afternoon, Monday afternoon, the trade was probably to the long side because you had the market too short. Now I want to go and I want to look at, let me take the overnight out again. I want to go back now and I want to look at yesterday afternoon. We had this huge break yesterday, and then the point of, if you look at the point of control from yesterday, the fairest price at which business was being conducted, the point of control did not migrate lower as the market went down in the morning. It did not migrate lower. And what I wrote for the people who got the report last night, I thought my first scenario was that we would trade within, open and trade within yesterday's range, a lower distribution yesterday. Second scenario was that we would look below that distribution and come back in. So what we did today, we did trade, we opened, we traded down, and then we traded back into that distribution. We don't trade, and you don't trade in a vacuum. Now look over here, you'll see that crude oil is off 59 cents. Here's the bar chart, and you see that crude oil is at new recent lows. Again, short-term traders have been following crude oil and putting some of their effect of how they trade this market has been based on what crude oil is doing. So that has got to be factored in. That's got to be factored in this morning. So I think that's what took place. But I want to show you yesterday morning. Remember, we started off and we pointed out that the low on Monday afternoon was exactly at a reference, and that market came back and bounced from there, came back through it fairly easy because it's probably weak trading. Yesterday, notice the early morning low one more time was exactly, I'm sorry, the reference was just one tick below it. It's right there. Yesterday's early break was exactly to that reference point again. So therefore, what this allowed me, when the market rallied, again, yesterday I'm saying this is probably a weekly reference. It's mechanical. The market rallied considerably. This low is at 23.4450. From there, the market rallied all the way up to 23.5625. We then came back down through that exacting reference. These are the kind of things that you have to notice if you are going to be able to really become a serious, profitable trader. They are nuances, they are important, and they are extremely easy to overlook if you get yourself mesmerized by price. And they're good references, they're good information, and this is why when we are teaching the last series that we call the intensive, this next series is called the mastery series, why we teach from a immersion standpoint. A lot of people would like us to teach, in a nice linear manner. You piece of information, you start with this and you mechanically go through it. What I have found by doing that, people cannot put all of the pieces together. We have found immersion trading, immersion education is far more relevant to how markets really work. They're not neat. But it's so much is involved in understanding what the people you are competing against are doing. And this is why, when we look at a reference like this coming down to exact level, and then we get what were the people who are competing against? They were using that exact level to buy. And that probably using short covering and also going long. Now, it is probably a very logical place to cover your shorts. It is also, but it's not as logical to be a buyer there unless you understand what's going on and you can reverse very quickly. But understand that probably is going to be taken out, or good odds it will be taken out, which it was again yesterday. So when we're talking about yesterday, this midday trading, yesterday afternoon, we're sitting there and we're talking about this distribution being a rotational trading environment late in the afternoon, and that's pretty common. Here's K, L. So once this forms, the lower distribution usually becomes a trading range. And remember, why did the market? We had this huge break in the morning, the outside day, the huge break, and then we moved sideways for a considerable amount of time in the afternoon. Remember that markets are like any other business. They are always searching for a level where two-sided trade can take place. In any business, unless there is two-sided trade, there is no real business opportunity. And that's really what markets do, whether it's on a short-term basis or a long-term basis. And that's what you saw yesterday afternoon. Once yesterday afternoon was once had lower distribution, we found a place where two-sided trade can take place, and that's what a rotational market is. It is just the evidence of that two-sided trade taking place. All right, now I want to show one more thing. Julia, are we ready to replay this morning?
Yes.
Julia, are you there? Okay, I'd like to replay this morning, and I want to show you a trade. Okay, so let's replay that, and then I will point things out.
Oh, give me 1 second.
Okay. To set up this morning, okay, remember that the crude oil was down. Crude oil was down. Overnight inventory was down, which meant overnight inventory was short. Okay, so as the market opened this morning, we looked down below yesterday's low, then we came back in, then we traded off again. Okay, are we close?
Yeah.
Okay.
Here you
so
go.
As soon as you're ready,
It's going to start momentarily.
Okay. Okay, so you see the market open. It opens within yesterday's range, trades off exactly to the overnight low. It bounced, and it trades off again. Comes back in, pit low, I'm sorry, takes the pit low out, thank you. Comes back in again, and notice it stops just short of unchanged, which is the blue line here. Couple ticks short. Usually when that happens, that's pretty mechanical, and it's not a sign of substantial selling at that point. Now, notice we came back through that. Now the market stopped this time exactly at unchanged. Again, the selling at exactly unchanged is more than likely weaker hands short-term trading. The market trades lower. Okay, at this point we leave a poor low, meaning the AB low, there's no excess. Highly unlikely that that will remain, particularly in the kind of volatility that we've seen in the last couple of days. Now, information I'm carrying forward at this time is that the morning high is exactly at unchanged. That is not a very secure high. I know oil is trading off. I'm looking at this now, and I don't have a meaningful low because there's no excess there. Okay, now here's stop. Can you stop for a second? Okay, what I have recorded now is look at my high. Julia, if you can point out the high, and it's exactly at unchanged. I already said that's a sign of mechanical trading. It is not a sign of serious selling at that level. Now we come back and we see the B period high on the rally is exactly at yesterday's pit session low. Okay, now at this point in time, one of the things that I say so often is when you become an experienced trader, you don't go looking for trades. You let the trade come to you. And a lot of times, people don't understand that. It doesn't make sense, and they say, well, I don't know what he's talking about. And they go back to doing their thing, looking at prices, and, you know, do I go long or do I go short, etc. But as I look at this, I have a questionable high. I have a point of control we haven't revisited from yesterday. I have a mechanical high in B period exactly at yesterday's low. I am now, with that information, if this market makes a new low, I am more than likely going to be a buyer. Okay, let's take a look and let's play this out.
Jim, someone's asking, what do you mean it's not a meaningful low?
Well, because there's no excess. There's no excess on it. There's no single prints. No sign of aggressive buying at that level.
Just
okay. And you'll see. You learn so much of this stuff by just observing the market, seeing how many times a high or low like that lasts. Okay, remember, I've already said, and I'm going to actually went through my mind today, I am looking for an opportunity to go long the market. And I'm looking for an opportunity to go long for several reasons. One, I don't think the high is secure. Secondly, the B period rotation high is not meaningful to me because it's so exact. So I don't have strong sellers when they're at exact levels. I have mechanical, weaker hands sellers, and they are the ones that reverse positions more rapidly. Okay, so now I'm watching this trade, and again, I said, remember, I'm seeing the potential for a trade to come to me. What do I need? For an opportunity, I need to take that low out. So we're just watching this develop. And for information, what on my trading screen, I have set up, I brought up the 2345 call options, because if I get the opportunity, I'm going to participate in this trade through call options. Okay, the market's back down near the low. Remember, said I didn't think that low was very secure or very meaningful to begin with. One more time, it holds that low. We're still watching it. You can speed it up a little bit if you want. So the other information I have, I don't like the high. I don't like the rally high in B. I know we have already been back into yesterday's range once, and if the market was really weak, we probably wouldn't have done that. Okay, so we're still watching this trade. We've talked about that low. Okay, I've now taken out that low. At this point in time, I step in and I buy my call options. Now somebody said, well, you know, why would you do it there? Because that was what I was prepared to do. The options limit my risk, so I don't have, you know, it's not the end of the world if I lose it. I don't want to, but it's not the same as being with the futures. And somebody will say, well, but it might have gone down. It might have gone down. These are calculated risks that I'm willing to take. So I waited until that low was taken out. As soon as that low was taken out, or within a couple of minutes, I'm long my call options. And some people say, oh my golly, how did you do that? We're almost at the lows. The market's down. Value's going to be lower. But remember the information that I was talking about. Let's just play this out and see what happens. But I'm showing you, again, this goes back to this idea of these mechanical references. I showed it to you from the Tuesday low. I showed it on the break yesterday. I showed it come back. These are the kind of observations that allow you to be a competitive trader in this market. Now you say, well, wait a minute. It looked like it was going, but it went back down again. Okay, so, you know, for a while it looked like it was wrong. Now you see the trade. And these are, you know, again, these are the kind of observations that I think allow you to get an edge over your competition. Notice that the AC high now is, I would call it poor. Again, it's exactly at unchanged. So who do you think selling exactly at unchanged? That is not stronger money. That's weaker hands trading. So every time they sell there, they are probably getting the market even shorter than it was. Okay, play it up at full speed, and then we'll go on to questions.
It's going to go pretty quickly now. I have it at a pretty fast clip. And then maybe you can, when I give you the screen back, you can show your options screen. I saw you had it up at the beginning of the webinar, but just so they can visualize, you know.
No, I don't have it. I took
oh,
it
okay.
down.
Oh, okay.
Okay. Okay, and you can see what's going on. Now, think of all the emotion you're going through as that trade was developing. But let's go back through the steps. One, last night I made the comment that, you know,
okay,
I thought.
I'll give you back the screen.
Good. Okay. No, I'm sorry. Leave it up there for a second.
Well, I'll
last
leave.
Night,
yep.
Yeah. Last night I wrote up that I thought we would probably trade within the lower distribution from yesterday. My second scenario was we look below it, come back in. We looked below it, we came back in, and so that, you know, then we traded down below it. But pieces to the puzzle. One, that was my view coming in. Secondly, the high was exactly at unchanged. That is not a secure high as far as I'm concerned. And notice I'm not fighting strong money selling at that. I'm fighting trading money. Then the market looked back down below yesterday's low. Second period, B period, came back up exactly to the tick. to the to yesterday's low. I now record that that is a very questionable rally high, and I've got, at the same time, I've got a poor low. I have an AB low with no excess. I call it an unsecure low, and I'm talking now about letting a trade come to me. This is extremely important. So now I'm already looking for the trade to come to me. I'm not going to do it while I have a poor low. Finally, that low is cleaned up, and at that point in time, I come out of it. I just click on the thing, and I buy my calls. I buy them at market. It's not a particular price. It's not a particular time. I want into the trade. I don't agonize over exactly where and all of this. I wanted you to feel what I mean when I say let the trade come to you. Anyhow, Julia, let's take some questions.
Yes.
Let me go back to my screen.
Sure thing.
I'm going to put you on mute for just a second.
You got the screen back. Unchanged is just Jim's way of saying yesterday's pit session close, and Jim uses the 4:15 p.m. Eastern Daylight Time close, not the close electronically that happens 5:30 when it reopens back up. So that's all unchanged is, because you're in a prop room and you see it go red, it's down from yesterday, it goes green. So Jim has always used unchanged.
Okay. All right. A couple other questions.
What is your profit target? You got in the calls down there.
Well,
How do you determine, where you're getting out? What is the destination trade? How are you managing that trade with the calls?
No idea. When I put the trade
still
on,
in them, or are you out? I guess you probably got
I don't know. I had an order to get in I had a limit order to get out while we were on the webinar.
You don't know if you got out. Yeah.
I think I'm out because well, my guess is I'm out.
And was this a trade for one day, just for today? He's trying to get a sense of your time frame.
Absolutely, yes, it was a trade for today only. It was simply a short-term trade, and that's why I wanted to show it to you. That but there was no exactness, and you say there's no management for the profit. I have no destination trade other than back to the point of control. And notice where it went to yesterday, or this morning, one tick short of yesterday's point of control. So that to me was a logical place for it to go. And at that point in time, I put in orders where I thought that the options would probably sell for at that level. Again, I can't be back and forth when we're on the webinar. But then once the trade is on, you're managing for continuation. So now when I look at this trade, remember what's going through my head. I showed you the daily bar chart. Let's go back to the slides for a second. I remember my longer term move, not necessarily longer term, but the next, few days, it wouldn't be a surprise to me if we go down to the 2300 level. So you've seen that, so you know that's what's in my mind. So with that, you talk about how I look for a trade and ask, was it a short-term trade? Yes, because it just looked to me like it was a case where inventory or short-term traders had gotten himself too short. And how did I judge that? I judged it. I thought it was a questionable high. I thought the rally high in B period was questionable. So I think short-term traders are probably getting themselves too short. And all I'm trying to do is take advantage of that. So you've got to keep in mind, from a next longer time frame, that's where I am, that the market can make its way down to the 2300 level. I don't know if it does. I don't know if it does or not, but it's certainly something that that is in my mind. Okay, now what other questions do we have?
Yeah, we have a question. Why did you not trade the futures contract instead of the options?
That is a personal choice. I'm, 77 years old. I have a lot of scars over the years from trading futures, and I have scars from trading options, but I like the options because I don't have to worry so much about exact entry. I don't have to worry about it much about stops. I don't have the same psychological pressures. Had I bought the futures this morning, I would have had a stop right underneath the overnight low. And with the options, I really didn't care if it took out the overnight low. I actually wasn't concerned with that. I wouldn't have been surprised if it did before it rallied. But if I had the futures, you had to be reasonable, and I probably would have been out of the trade once it traded below the overnight low. With the options, it gives me a little bit more room, and I don't have the same psychological pressures. It's strictly a personal choice. It also gives me some other alternatives. And for example, when I saw what the market was doing early on, I bought some puts, and then I was able to sell the next higher strike price put against that put buy at more than I paid for the original put. So it's a risk-free position. It gives me other choices, and sometimes I may actually trade futures against the long puts and calls. Anyhow, a couple more questions before we wind this up.
Yes. Well, let's talk about yesterday. When yesterday opened yesterday, it gapped lower, it filled the gap, it went higher, filled the gap, and proceeded lower in the direction of the initial gap. How did you handle yesterday's open, and do you have any comments about that market situation?
Yes. One, I knew the price was up from overnight. And as you already know, I wasn't, the low, remember the low from the previous day, I thought was suspect. It was so mechanical. I watched the market open yesterday. It looked above, it came back to exactly, I think exactly the high of the previous day. It rallied again, and it was very, very weak. There was no real up or real up tempo to the upside. At that point in time, I loaded up on the puts. I had some puts. I had some puts coming in. They were hedged from the day before with long futures. Overnight, I had sold the long futures. I had exchanged the long futures for calls in order to give me a hedge in case the market went straight up. And as soon as the market started to break yesterday, I added to the put positions, I closed out the calls, and I stayed just with the puts. But again, remember, if you go back to what I wrote on Sunday, you know I had a question on the market from the time, particularly from the Fed rally forward. That looked like a very poor rally to me for the reasons I stated earlier. I wrote on Sunday night I was trading the market from the short side, so I had an opinion. I had an opinion on the market, but I still will hedge that from time to time because I know things don't always happen directly. They don't go from bull to bear, even in the very short term. It very often is a process. In the process we saw, the low on Tuesday gave me more information because it was exactly at a previous low. So when I'm talking about letting a trade come to me, I had puts that got down there. When it stalled there, I bought futures to hedge that. And then when it looked above the yesterday's high and it was just so lethargic and no real carry through, and at that point in time, came back in. At that point in time, I was comfortable that the trade was coming to me, and at that point in time, I exchanged or made the position more negative. All right, a couple more questions.
Yes, There's a question, so when Jim says he bought the call, does he mean at the money calls? And one thing I want to point out, because there's a lot of Mastery Series traders in here, that at the training site, when you're logged in, there are, on the right rail, options webinars. And we do options webinars. It's not a focal point. It's not a primary teaching concept for the Mastery Series or our past intensives, but many traders are curious how Jim trades options. So we have recorded all the options webinars, for those traders that are interested. It's not a primary part of the program, but I see a couple of questions about Jim's options trades and their Mastery Series traders, so please go in and check out those options webinars and you'll have a much better sense of how he trades options. And there's also an options worksheet there under trading tools that help you determine what options to buy based on Jim's analysis. So the question, Jim, just to come back to this, so when Jim says he bought the call, does he mean at the money calls?
No, I think I said earlier, I bought the 23.45 calls. I bought the 23.45 calls as the market took out that poor low we were talking about. So I will buy out of the money because I want the leverage, and it also helps me reduce risk if I happen to be totally wrong, which of course has happened. Okay, another
Jim,
couple of questions.
Can you make your screen a little larger? Now that we've been at the point of control and we've tagged that, I guess we're one tick shy of it in this, short covering rally. What do you see happening now? Pull out your crystal ball, and what are your thoughts on this afternoon and current market profile structure?
Well, I'm looking here and I'm saying, okay, am I enamored? Let me put the overnight back in there.
It might be today. Okay.
There's the overnight. Notice that the morning low is just a couple ticks above the overnight low. So I'm not enamored with that low.
The point of control has been migrating higher, though. You can see the yellow ABC and then the yellow, you can see how it's migrated higher. Pardon me for interrupting.
Yeah. But I'm looking and I'm saying, okay, we're getting well into the day. This is a very mechanical high, so I'm not enamored with that high either. But value is developing as overlapping to lower, and value is a very important consideration. What we do. So we've had a short covering rally. Value is lower. So this goes back. I don't know how the day ends, but it hasn't had a lot of pizzazz. Once it got to the point of control, it's just kind of died. So I think there's a lot of confusion out here. And incidentally, looking at the references this morning, mechanically down here and how hard it was to take that low out, couldn't take it, and coming exactly to here early morning, being exactly at unchanged, tells me that I still don't have any indication of longer-term institutional selling in this market. What I'm seeing so far, what I think I saw yesterday was liquidation. Sure, you got some, but I'm seeing liquidation of a lot of weak longs that have been in this market for some period of time. I think that was the end of Fed day, because they took back. This was Fed day, so they took back all of the longs from Fed day. And notice once they took that out, once they took the Fed day out, that's where we got the big crush down yesterday. So I think we had a lot of long liquidation. I still don't see any indication so far of having any serious long-term institutional selling in this market. That doesn't mean there aren't smarter people that have been unloading. But, yesterday's volume was up. I think it was 4.2, 4.3, something like that. So it's clearly up over the previous day, but not huge volume by any stretch of the imagination.
Can you slide your profile up so we can see the low? Someone's asking, we're one time framing higher now. Is that of any relevance to you?
Not particularly. I mean, what I'm looking, I had this inside bar in E period. I have an inside bar in F period so far. The market's just coming into very short-term balance. I don't have any great opinions for the remainder of the day.
And a question, let me find, hold on. Yeah, I asked that, Stan. We say that a poor high or low means that the market got too short or too long, too short, respectively. But in A and C period, we had a poor high. They were matching 30-minute period highs. And D period broke through the poor high. Would you please explain that process?
I can't. I mean, it just happens. Remember, you got a lot of chop in the market. There's a lot of chop, there's a lot of uncertainty in the markets, and there's just so many different buyers and sellers with so many different views. So and that's why I say you have to kind of step back and be very selective at the information that you look at in here. You've got to accept the chop in there. So I can't explain all of those things. And then you can't. You're never going to have a complete understanding of the market. We have suggested that you take, if you're a short-term trader, we have suggested that you take the need for closure scale quiz. It's on our website. It's in New York Magazine, and it's an interesting quiz. People that struggle with short-term trading. One of the things that it shows that people that have a high need for closure have a need for exactness, and they don't handle uncertainty very well. People that have a lower need for closure are better positioned or better capable mentally of handling complex, uncertain situations. And the irony of it is that the real opportunities as a trader lie in the uncertainty, because there's so many people confused, and if you can sort through that, that's where your opportunities. I mean, I walked you through a trade today. Now I understand that's there's a lot of information, and I said I waited the trade come to me, and I showed you why, and at the time I'd asked Julia to record that because I wanted to show you what it looks like. It's clearly not simple. If you are overly focused on price and volatility of price movement, you're not going to be able to execute that trade. You need to have, there has to be a calmness. You have to be able just to let this market, develop and let the opportunity come to you. But if you're overly anxious, then it's going to be very, very difficult. So there's a very strong, as we say, it's market understanding and self-awareness that are so important to providing the package that makes you a good trader. I want to go back to the beginning slide. Are you ready to get serious? Information is the driving force of all markets. Information has no power until someone acts on it. Understanding human nature is the key to understanding the totality of the auction process. Now that is a huge statement. And does it take time to accumulate that knowledge? Yes, it does. And that is the reason that Julia came up with the idea of doing these extended educational periods. When we used to do programs in a hotel room, in a big hotel thing, we got a lot of applause, and people loved it. Seminars, and people loved them. The last day we talk about quite often, we got a 400-point rally that we said, and the market opened in the morning. We said maybe a day that opened weak and closes strong, and boy, everybody thought that was great. But the truth of the matter is, walking out of a 3 or 4 or 5 day program on a stage in a hotel room, seminar doesn't really equip you to start to have an understanding of the market. If you look at the current program we're doing, when we started we added 7 weeks of the Kickstart program. And now we're not doing the full thing every day, but we added 7 weeks in order to give you a little head start. When you combine all the programs, you've got well over 100 days of having this information shown to you. It gives you a chance to begin to absorb and understand what markets are really about. And I understand, you're not going to be these profitable, wonderful profitable traders after 100 days, but hopefully it gives you a much different foundation in order to begin to appreciate and understand that these markets are understandable. And a lot of times, it just maybe something else came into my mind. A lot of times we hear people give excuses that, well, with the high frequency traders and the algorithms out there, we can't compete with that. My position has been all along that really doesn't bother me. I actually think it works in my favor. But there was an article in the paper this morning that the journal that I think it was in the journal, I don't remember for sure, that these high frequency traders have come under a lot of pressure. And my comments early on were, once one works, somebody else will build a better system, more expensive, and that's what happens. The competition is fierce. The profits in that industry have gone from almost 8 billion down to 1 billion. They're having a terrible time. You got to spread that over a lot of people and a lot of costs. So again, the things that we're talking about, they haven't reached the computer skills yet to do what we talk about. And this understanding of human nature is so important to understanding the auction process and being able to get in the flow of the market. Anyhow, that's really my commercial as to, to join us for the Mastery Series, because that's what we're trying to do. We're trying to give you a much different way to think. What we're trying to do is help you understand how to think about the markets. A lot of time people get concerned. Well, you don't tell me where to buy, where to sell. Nope, I don't. I don't know where to buy, where to sell. I may have a ballpark sometimes. You saw one this morning. Exact price, exact levels, I don't know. I then manage the trade for continuation. So, I mean, there's a lot of complexity to it. But remember, you're not going to compete. You're not going to compete successfully unless you really can master the human understanding. Anyhow,
okay.
Unless there's something really urgent.
A couple of things. Everyone, if you want to take the need for closure quiz, we have that at our blog. So if you can just jet over to jdaltontrading.com, click on the blog, and there's a link there. I think it's a New York Times quiz, but there's a link there that'll take you over.
New York Magazine.
New York Magazine, thank you. And a couple of questions, if we may, Jim, before we sign off.
Sure.
Okay. Would the D period high be considered weak if you could put up your profiles because it came one tick from today's point of control?
Yeah, of course. I mean, as I said earlier on, it's a questionable high. It's a mechanical high. It's one data point. The answer is yes.
Okay. Wouldn't today's low be weak also because, and you might have to pull up your TD bar chart, because it's at the February 16th and 17th lows?
Yep, I've already said it. And the overnight low was exactly at that level, and today's low, absolutely. It's a good observation. And, so the high is questionable, the lows are questionable, but you net this all out. Remember, value's building lower today. You remember when I showed the daily bar chart that there's really no support down to the 2300 level. Whether we get there or not, I don't know. But again, it's very common for us to work our way down there, but it's not in a straight line. So, you can find all nuances, but remember, overall, value's building lower, overlapping to lower today. All right. Let me say thank you very much. I know we didn't get all the questions answered. There were too many people in the, on the program. But remember, this is, we'll repeat this with Shadow Trader and Peter Resnicek tomorrow afternoon.
4:30.
That's at 4:30 Eastern Time. And one of the things you'll find if you and listen to two of my programs back to back, sometimes you say, did I really hear that before? they're usually not the same. Other information comes to the surface. Other things have taken place in the meantime. The basic information remains the same. The nuances may vary somewhat. Anyhow, thank you all very, very much, and I hope you join us for the Mastery Series. Thanks.
And yes, everyone, if you hang out for a second, I was just going to show you, because you know this is probably of interest to you. You're looking at my screen. This is the training site. We have a dedicated training site for the Mastery Series and all the intensives that we've done. So if you want to be a part of the Kickstart program, you'll see here Kickstart reports, and we post the reports here as a PDF to be downloaded. You'll also see under webinars, we have the upcoming Kickstart webinar, the recorded Kickstart webinars, and of course recorded webinars are all our past intensives back to 2013. That is secured content. But anyone in here, whether you're a part of the program or not, you can get to the Kickstart reports and the upcoming Kickstart webinars and the recorded Kickstart webinars. So this is available to you as well as our public site. And I think that's all I wanted to say about that. If you have any questions, you're always welcome to call me or shoot us an email at jdaltontrading@gmail.com. We also have a chat now right on our homepage that you can type right in there. And I'm tethered to my desk, so I'm sure I will get it and get back to you. Okay, so thanks everyone. It's so great to have you here, and we appreciate you being a part of it and staying to the end. And we will have this recording posted at jdaltontrading.com under webinars within the hour. And it'll be also posted at YouTube and Vimeo for your convenience. Okay, that's it. Have a great day wherever you're at, and we'll see you back here on, let's see here, next week. Our upcoming webinars, we have another public webinar, trading the final hour. So next week on Wednesday, that's our next webinar. You can go and register at jdaltontrading.com. And tomorrow we have our Kickstart webinar, which is at this website, training.jdaltontrading.com. You can register for the Kickstart there. Okay, so thanks so much and have a great day wherever you're at. And thank you very much, Jim. Fabulous presentation. And we'll see you back here next week, or we'll see you tomorrow at the Kickstart webinar. So long, everyone. Bye-bye.